Wall Street just discovered a cheat code. Buy $1 of Bitcoin, put it on a company balance sheet, and watch the stock market pay you $2 for it. It's the financial equivalent of going to a garage sale, spotting a $1 bill on the table, and paying $2 for it. And somehow, every major institution on the planet is currently doing exactly that. This is the story of the worst trade in the history of the stock market. And the genuinely insane part is that it's still unfolding in real time, right now, as you watch this video. I've broken this down into 3 parts: the origin, why it works, and why it falls apart. And by the end, you're going to understand something that most professional investors are actively trying not to think about. Part 1. How a dying software company accidentally broke the entire logic of financial markets. Let's go back to 2020, specifically to a company called Microstrategy, which was quietly having one of the most low-energy corporate crises in history. Microstrategy was an enterprise software company, which is about as exciting as it sounds, with declining revenues, a shrinking customer base, and a stock price that reflected the enthusiasm of someone watching paint dry. Their software business was going nowhere. Their competitive position was eroding. Their future roadmap read like a corporate hostage note written by a consulting firm. Then CEO Michael Saylor had an idea. In August 2020, Saylor announced that MicroStrategy would no longer be holding its cash reserves in U.S. government treasuries like a sensible, liability-conscious, grown-up company. Instead, they would put the entire cash reserve into Bitcoin. To understand the magnitude of what that statement meant, corporations have held excess cash in safe, liquid, low-volatility assets, treasuries, money market funds, short-duration bonds, since the concept of a corporation was invented. The whole point of a corporate treasury is that it doesn't surprise you. It doesn't lose 10% of its value on a Tuesday because someone in South Korea decided to sell. Michael Saylor looked at 200 years of corporate treasury convention and said, "Interesting, what if we didn't?" At the time, the reaction was split almost perfectly between "this man is a visionary" and "someone call the board." It turned out both groups were partially right. But here's the thing. Saylor didn't stop at converting the cash reserve. By late 2020, he had moved to phase 2, raise external capital by issuing convertible debt and use that borrowed money to buy even more Bitcoin. Not Bitcoin with cash they had, Bitcoin with money they borrowed. Then do it again. Issue more debt, buy more Bitcoin, repeat. This is the point in most corporate stories where the risk management team intervenes. MicroStrategy apparently did not have one of those. Fast forward to 2025, and the transformation is complete. MicroStrategy dropped the micro from its name, a M, and rebranded to just Strategy, to signal unambiguously that the software business is no longer the identity of this company. Strategy now holds approximately 600,000 Bitcoin, purchased at an average price of $71,000 per coin. That Bitcoin position is worth roughly $70 billion. Strategy's market cap, $138 billion. Their stock performance since 2020, up over 3,400%, making it one of the best performing equities on any major exchange over that period. Every boardroom in America quietly opened a new spreadsheet. What happened next is a Rorschach test for your views on market efficiency. Companies with absolutely no connection to cryptocurrency began announcing Bitcoin treasury strategies. A gaming company based in Hong Kong, a cardiovascular healthcare company, a budget hotel management group operating out of Japan. The strategy was identical in every case. Announce the Bitcoin purchase, watch the stock price jump on the day of the announcement, repeat the announcement with a larger number next quarter. None of these companies had any logical reason to be in the Bitcoin business. All of them got a short-term stock pop the moment they entered it. And this is the point where the Dunning-Kruger effect meets the balance sheet. CEOs who watched Strategy's 3,000% run concluded that the secret ingredient was Bitcoin on the books. They were half right. The real secret ingredient was being early, and that ship had already sailed. But when has that ever stopped anyone? Part 2. Why the most sophisticated investors in the world are doing something that makes no sense. To understand why this trade even exists, why anyone pays a 100% premium for indirect Bitcoin exposure, you need to understand one concept: institutional mandates. pension funds, mutual funds, sovereign wealth funds, insurance company portfolios. These entities collectively manage tens of trillions of dollars, and every one of them operates under a legal document called a mandate, a detailed set of rules specifying exactly what asset classes, risk profiles, and security types the fund is permitted to hold. Mandates exist to protect the end investors, the retirees, the pension holders, the people whose savings are in these funds. Many of the largest funds in the world have mandates that explicitly prohibit direct ownership of Bitcoin or other cryptocurrencies. They wrote those rules themselves, their boards approved them, their lawyers signed off, and now they want Bitcoin exposure. Not because their views on crypto have changed, not because they've suddenly become believers, because their clients want it, because competitors are getting it, and because ignoring it has started to look like a bigger risk than owning it. So they found a workaround. Strategy, a company whose entire asset base is Bitcoin, is technically a publicly listed equity. Equities are permitted under virtually every institutional mandate ever written. By buying Strategy stock, these funds get indirect exposure to Bitcoin's price movements without technically violating a single rule in their investment guidelines. And here's where it gets genuinely funny. The Vanguard Group, one of the most publicly anti-Bitcoin institutions in finance, a firm that has repeatedly and loudly stated they believe Bitcoin has no place in a serious investment portfolio, is currently the single largest shareholder in Strategy. Vanguard hates Bitcoin. Largest investor in the Bitcoin company. Read that sentence again slowly. This is not a contradiction they are unaware of. This is a contradiction they have chosen to live with because their mandate doesn't let them buy Bitcoin, but it does let them buy a company that is 90% Bitcoin. The financial system is sophisticated enough to generate trillion-dollar funds and legally binding investment frameworks, and yet somehow produced a situation where the most efficient path to owning an asset is to buy a company that owns it at double the price. Here's the number that makes this tangible. Strategy holds approximately $70 billion of Bitcoin on its balance sheet. Wall Street has priced Strategy, the wrapper, the vehicle, the workaround, at $138 billion. That is a 100% premium. For every dollar of Bitcoin inside Strategy, you are paying $2 to get to it. These are some of the most analytically sophisticated investors on the planet, people with PhDs in quantitative finance, running multi-billion-dollar allocations, and they are voluntarily paying double the sticker price for an asset because a document their own lawyers wrote won't let them buy it directly. In this entire situation, every premium, every workaround, every gymnastic maneuver could be resolved by changing one line of text in one document, one mandate update. The whole premium evaporates overnight. They haven't done it. Part 3. The part where it falls apart. On the surface, Strategy's operation looks elegant. Step 1. Issue convertible debt. Step 2. Buy Bitcoin with the proceeds. Step 3. Watch both Bitcoin and your own stock price go up. Print infinite wealth. The problem is that this model contains a structural vulnerability that almost nobody is talking about, and it has nothing to do with Bitcoin's price volatility. The risk is in the debt. Here's how convertible debt works. Strategy issues bonds to investors. Those bonds pay interest. When the bonds mature, Strategy has two choices. Option 1, repay the principal in cash. Option 2, bondholders can elect to convert the debt into shares of Strategy stock instead. In a bull market, Strategy stock rising, Bitcoin rising, bondholders will almost certainly choose to convert to stock. That creates share dilution, which puts pressure on the stock price, but it doesn't threaten the company's solvency. The dangerous scenario is different. Bitcoin drops significantly. Strategy's stock price collapses alongside it. Bondholders look at the stock and decide they'd rather have cash than depreciated equity. Now, Strategy needs to repay the debt principal in cash. Their balance sheet is overwhelmingly Bitcoin, which is currently down. To raise cash, they have to sell Bitcoin into a falling market. Selling Bitcoin into a falling market pushes Bitcoin's price down further, which makes Strategy's position worse, which increases the pressure to sell more Bitcoin. This is a reflexive unwind, the kind of feedback loop that doesn't just hurt Strategy, but ripples into the broader Bitcoin market, because Strategy is one of the largest single holders on the planet, 600,000 coins. If they're forced sellers, everyone who owns Bitcoin feels it. So let's zoom out and look at what we actually have. A former software company, which pivoted to Bitcoin in 2020, has reinvented itself as a glorified Bitcoin vault with a stock ticker and an investor relations team. That vault convinced institutional investors who officially dislike Bitcoin to pay double the value of the assets inside it. Those institutions are paying double because a rule their own lawyers wrote won't let them buy the asset directly, a rule they could change at their next board meeting. The wrapper they're buying instead is financed by convertible debt, meaning that if Bitcoin drops hard enough and stays there long enough, the structure could experience a forced, accelerating unwind. The people managing this exposure are institutional portfolio managers who have outsourced the actual Bitcoin custody and debt management to a company whose primary qualification for the job is that it did something crazy in 2020 and it worked. This is not a financial strategy. This is a bureaucratic workaround that became a $60 billion trade because nobody wanted to update a document. And the genuinely frightening part, it is still working. Right now, today, institutions are still buying Strategy at 100% premium over the value of its Bitcoin. The music is playing, everyone is dancing, and nobody in the room wants to be the person who asks what happens when it stops. So I will. If you were running a multi-billion-dollar pension fund with a mandate that blocked direct Bitcoin, would you keep paying the double price wrapper, or would you change the mandate? Because one of those is a financial decision, the other one is just inertia. Drop your answer in the comments, and if someone you know is holding Strategy stock, send them this video and let them tell you which one they think their fund manager is doing.